Our first speaker is Marco Colantonio from Resolution Capital. So as interest rates rise and the capacity of buildings increases, as well as utilization of the different types of property, there are many questions that investors have been asking about, what's the true value of a building, how much rental income can it generate, as well as, how does occupancy filter in, and, in terms of rentals increasing at quite a rapid rate, how does all of this fit in? So these are just some of the topics that Marco will address during his presentation. Just a little bit about him. He is a portfolio manager at Resolution Capital and is one of the 4 PMs who manage the Nedgroup Investments Global Property Fund. So it's interesting because they have an incredible track record of about 16 years where pretty much they've outperformed the global REIT index over every rolling 5-year period, which is certainly quite brilliant. Marco, welcome, and how are you?
Good, thanks, Anil. Good to see you, and it's good to be back as well. Thank you.
Excellent. Same here. Nice to see you again. So, Marco, we'll hand over to you for the next, let's say, 10 or 15 minutes or so, and then we'll take some live questions from the audience. Thank you.
Yeah, great. Thank you, and thanks everyone for joining. Look, as Anil said, for the quarter ending 30th of June, it certainly has been a tumultuous time in the markets, coming under a lot of pressure as a result of the confluence of geopolitical, economic, and of course policy headwinds. And so global REITs were not immune from this tumult, with the global REIT index being down around about 17% for the quarter, and marginally underperforming global equities, which were about -16%. And within the real estate universe, as you can see at the bottom of this slide, I hope, is that the weakest subsectors within the real estate universe were some of those that have been performing quite strongly in recent periods, and we're trading at elevated multiples. So the likes of industrial and self-storage REITs came under a bit of pressure, as you can see at the bottom of this slide. And on a regional basis, Europe was quite weak within the real estate markets at about -26%, and that was mostly attributable to the more highly levered stocks in that region. Meanwhile, in Asia, the REIT markets held up relatively well, as we saw some rotation into value. These stocks have been performing fairly poorly for the long period of time. And in the case of Japan, where the central bank has, at least so far, resisted raising interest rates. In terms of the fund performance, the Ned fund performance over the quarter, we're disappointed that we were slightly below the benchmark for the quarter at -17.7%. And I'll go over the main drivers of that in the next slide. But as you can see here, over the longer time frames, we have generated alpha of around about on a range of 120 to 270 basis points per annum over the various time frames shown here. But turning specifically to the most recent quarter in terms of the attribution, we had positive contributions from obviously from our cash exposure in a falling market. We had an average of cash of about 5.5% through the period. On a sectoral basis, our overweight to residential contributed positively. Now, within that, our exposure to a US student housing REIT called American Campus Communities contributed particularly strongly, which it was because that particular REIT was the subject of a takeover bid by a private equity firm, Blackstone. So for us, a little bit of a bittersweet outcome in that it's good returns, but it removes this really interesting platform from the public markets. We do like the student housing platforms because they typically are more resilient in economically challenging periods, and that's one of the reasons why we held it at the time that it got taken over. And in fact, M&A activity was also a feature in the data center sector, where we had some positive returns as well, where one of our portfolio holdings, Switch, also received a takeover offer at a healthy premium. Now, offsetting some of those positives in the retail sector at the bottom of the scale here, we don't have any exposure to some of the net lease landlords, like Realty Income Trust. It has very long duration leases with minimal rent review opportunities. And so in an inflationary environment, we've avoided those kind of exposures, but the markets seem to be more focused on the recessionary resilience of those types of cash flows. And so that stock performed particularly well. And for similar reasons, some of the diversifieds, like the gaming REITs, Vici, also performed well, and we have no exposure to that. On the right-hand side, on a regional basis, our underweight exposure to Europe was a positive. As I mentioned, a lot of highly levered names, particularly in Germany and Sweden. Those stocks had been performing exceptionally well in the preceding years when they enjoyed negative interest rates, and unfortunately, management kept on taking on more and more leverage to boost returns. But now they are facing very much a reality check as local interest rates rise quite dramatically. Offsetting our relative gains from continental Europe was our underweight exposure to the less impacted Asian real estate markets, where, as I mentioned, stocks screen quite cheap after having been poor performance for several years. But in an environment, as I mentioned, with the Bank of Japan keeping rates low, that helped the Japanese market and the other markets relatively insulated as well. We've long struggled to get enthused about many of the Asian stocks due to a lack of focused strategies and poor governance, and so that's why we're underweight there. It's worthwhile putting the recent REIT returns into perspective. And on the left-hand side here, you can see the returns of various liquid asset classes for the first 6 months of this year. Obviously, it's been a time when central banks have been withdrawing and reversing stimulus and had a rapid rise in interest rates from very, very low levels. And of course, I think what this shows is, as we've been saying for a long time, interest rates matter. They matter to all asset classes. And so the drawdowns have been relatively widespread, albeit it has impacted some of the more speculative parts of the market, such as crypto and profitless tech more acutely. Global REITs performed roughly in the middle of the pack, broadly in line with the equities market. And while these drawdowns are uncomfortable, it's important to keep an eye on the longer term. And so on the right-hand side chart here, we show Resolution Capital's global REIT strategy, which was launched not long before the global financial crisis, and it quickly experienced a drawdown of close to 40%. But as you can see, over the longer term, the strategy has delivered competitive total returns and well ahead of the benchmark, with our focus on strong balance sheets and landlord pricing power. And so when it comes to landlord pricing power, I guess it's topical to discuss where we're seeing the best exposures and where we see economically relevant real estate, where the landlords have the best prospects of delivering real growth in cash flows. Now, currently around 60% of the portfolio is exposed to 3 buckets that we highlight here, and we've neatly abbreviated into beds, meds and sheds. So beds refers to rental homes and apartments and manufactured housing communities. They're benefiting from the housing shortage that we see in many markets. And importantly, they have short-term leases that can capture market rent growth, providing a good inflation protection. The meds category refers to healthcare real estate, so the likes of seniors housing, life science labs, medical office buildings and clinics, which are typically less economically sensitive, but importantly, they're also benefiting from the ageing population trend and the huge investment in medical science that's been going on for the treatment of so many unresolved human diseases, let alone just COVID. And the third bucket being sheds, which is a reference to logistics, which has been benefiting from e-commerce and also the need of many companies to improve their supply chain resilience. And it also includes data centers, which is benefiting from digitization, and self-storage, which has been enjoying very strong occupancy and rent growth and short leases. Now, just on logistics, we did recently trim some of our big box industrial exposure due to some of the supply risks that we see in that space, but we're still quite constructive the more infill logistics markets. And just quickly, some of the slides just showing the diversity of sectors that we have in our portfolio. A nice range of economically relevant real estate where we think pricing power is intact and landlords continue to increase rent, or we can find some defence if the economy was to weaken dramatically. So we have an overweight exposure here to healthcare and the residential sectors that I've outlined. And from a regional perspective, just moving through these slides quickly, our underweights, as I mentioned already, to Japan and Singapore, overweight to UK and the US, where we typically find the better balance sheets and the sector specialists that we prefer. And another key attribute of the portfolio that I wanted to touch on was the top 10 tenants here. You can see on a look-through basis, only one tenant is larger than 50 basis points of exposure in the portfolio, and that's the NHS, so effectively the UK government. And this diversity is important because it underpins the income from the portfolio. Having a broad range of underlying tenants limits the risk to any one tenant falling into financial difficulty in the event of an economic slowdown, or indeed if a particular tenant decides to vacate an asset. Now, topical is real estate and inflation. We believe real estate can act as an inflation hedge, and you can see on the left-hand side of this chart of this slide, the chart showing that over the last 25 odd years, REITs have been able to produce rental income growth greater than core inflation. And that's a result of a combination of factors that we've continued to highlight. In the short term, you have leases that are either directly linked to inflation or have contractual fixed increases, typically in the range of 1 to 4% per annum. The trend has more recently been to the upper end of that range in more recent leases. And the other factor that leads to real estate being an inflation hedge is that there is a link between real estate rents and replacement costs. So all other things being equal, higher building costs usually means that a developer needs higher rents to justify new construction. And so in a rising construction cost environment, which we clearly are having, as you can see on the right-hand side of this slide, it will either have less development, which means less competition for existing buildings, or the newer buildings that are developed will need higher rents to make them stack up financially. And so that's some of the dynamics that we're seeing at the moment, and we believe the combination of these factors, which make development at the moment more expensive, more risky, and longer to deliver, is actually reducing supply and can be beneficial for existing landlords. Of course, for these conditions to be in place, it's crucial that tenant demand is greater than supply. And so let's have a quick look at the real estate fundamentals as we see them today. On the left-hand side, you can see REIT occupancy levels are actually very good, well above the long-term trend. And of course, that potentially could change if we move into a more recessionary environment. But at least REITs are starting from a relatively good position of high occupancy. And on the right-hand side, just illustrating that supply picture, supply at the moment as a percentage of existing inventory is tracking at around about average long-term levels. And so we don't see too much issues from a supply point of view. We obviously delve into a bit more detail on an individual sector basis when we dive into, sorry, I was on the wrong slide there, wasn't I? Into individual sectors, but broadly speaking, we can see on the left-hand side, rents can match or exceed inflation, and on the right-hand side, construction costs spiking is actually good for existing buildings. The other factor that's really important is capital structure. Now, we've moved into an environment where capital scarcity and the rising cost of capital is an increasing concern. And in recent years, obviously, REITs have been enjoying the positive benefits of leverage from, as asset values have increased and earnings have benefited from falling interest rates. We now face the prospect of these positives turning into negatives, with asset values coming under pressure potentially, and earnings beginning to fall if rates rise. So for these reasons, we've long preferred lower levered vehicles from both a capital preservation point of view, but also to enable companies to take advantage of the distress that may occur. And when we look at the way the REIT sector is positioned at the moment, the balance sheets are in reasonable shape. Leverage is lower than it was in the GFC, the debt maturities have been extended, and there's hedging in place to at least cushion the impact of higher finance costs in the short term. And the chart here on the right-hand side shows leverage of the different regions. And it's important to note that some markets haven't really learnt the lessons of the GFC. Japan, Europe and Singapore all running with higher leverage. And they're all markets where our portfolio has limited exposure, as I outlined earlier. And that's largely because of the higher leverage that we see in these portfolios in those regions. Our portfolio has an average loan to value ratio of around about 25%, so the lower end of the range that you see on this chart, and we think that provides an important buffer that you may need in these potentially challenging times. So let's have a quick look at one of the largest stocks in our portfolio. I'll profile Kimco Realty here. It's a US grocery anchored shopping centre portfolio. $22 billion worth of assets here in this portfolio. 85% of the assets are located in major metro areas. It caters to the daily necessity and services needs, and these are located within 3 to 5 miles of the local consumer. Obviously, during COVID, these type of centres did experience quite a bit of disruption due to the lockdowns, but that experience actually magnified the demand for that type of real estate as retailers began to appreciate how important these last mile distribution points are to their customers. And so coming out of COVID, both the tenants and the investor demand has rebounded very, very strongly. It's got a solid balance sheet, and as I mentioned, good necessity-based needs, underpinned by low land values at around about $250 a square foot, which enables them to consider alternate uses like adding residential, which they have the potential to do with approvals for around about 13,000 units on their existing land. So look, pulling it all together, we've certainly moved into a macro environment which is very different, dealing with the consequences of the largesse of stimulus of recent years, elevated inflation, rising interest rates. All these things are creating challenges for asset values across the board. And within that context, we think that REITs are relatively well positioned. We look at the supply and demand fundamentals, and we think they're in decent shape. And rising construction costs and delays and rising finance costs are making it more difficult for developers to bring on competing supply. We look at the balance sheets of the vehicles, generally in good shape. We see moderate leverage and reasonably lengthy debt maturity profiles. And we believe REITs and real estate have the ability to serve as an inflation hedge, particularly those segments that have got pricing power, landlord pricing power. And on the right-hand side, compared to the underlying real estate markets, REITs are now trading at a discount, and typically that closes over time. So either REITs will recover, or the underlying real estate values will trade back down. And if REITs continue to trade at this sort of discount, then ultimately the arbitrage will be closed either way. And often, and as I referred to, REITs have been a happy hunting ground for private equity, including the student housing portfolio that I mentioned earlier, as these private equity firms seek to deploy large licks of capital that they have into the high quality listed REIT platform, so providing some underpinning to the REIT returns. So I'll finish up there, Anil, and hand it back to you in case you have any questions.
Thanks very much, Marco. There actually have been a couple of questions. Fortunately, you've covered most of them during your presentation. There's actually just one more, which we're out of time, so we'll send you an email later and get back to that person on that particular question.
Sure.
But otherwise, thanks very much, and we appreciate your time and all the good work that you and your team do on the fund.
Thanks very much.